Hello everybody, it's Tom Sheridan and Chris Darbyshire from 7 Investment Management. We're here to talk about the Q4 asset allocation discussions that we've been having, what those discussions were, and importantly, how they're going to impact the portfolios that hold your money. The kind of things that we want to talk about are the first couple of months after the Brexit vote. After that, the role of central banks, and are we seeing the beginning of the end of QE? The political landscape is becoming much, much more important these days. And of course, finally, how do we synthesize all of that into portfolio decisions to protect and to grow your capital? Chris, the last time we were here, we had just had the Brexit vote. We had had a bunch of surprises, including the vote itself. And what seems to have evolved since then is a discussion in terms of, are we going to have a soft Brexit or are we going to have a hard Brexit? Can you explain what the two are and then your thoughts on that?
Yes, so a soft Brexit is a Brexit that looks very much like the status quo, but a little bit more removed from Europe. So we don't have complete power over immigration from Europe, but we're still members of the single market. So it's really business as usual. And a soft Brexit would be very good for the pound, which has been really the major casualty of the referendum so far. Now, a hard Brexit is a more clear break from Europe, where we, put up barriers against immigration from Europe, but we do not have access to the single market, not a clear, unfettered access to the single market. And now we're looking for trade deals abroad with China and the US and Australia and so on. Now, that outcome involves a lot more uncertainty, and we would expect the pound to stay pretty weak if that's the path we're going down.
And we have the open question as to whether or not the Europeans would allow a soft Brexit. Are they going to give us essentially what it is that the UK wants, having voted to leave it? And then, of course, is that what the UK voted for in the first place?
That's a really good point. I mean, at the moment, they are positioning to force us down the route of a hard Brexit unless we play ball and give them everything they want.
Okay, so from a Brexit standpoint, it's going to take up to 2 years before we actually know the answer, but gradually we'll get an inclination as to which way it's going to go. From a portfolio management standpoint, Chris absolutely favors the soft Brexit option, and that's one of the unknowns that we're keeping our eyes on. Now, moving past Brexit to the very, very important role and the very visible role that central banks have played really for the last 8 or 9 years. Are they running out of ammunition now, Chris?
It's interesting because, of course, the Bank of England's been very active, increasing QE, so trying to increase the monetary stimulus. But I think pretty much all the other central banks are beginning to take a step back, are beginning to think, is any more unconventional monetary policy going to do much good? So the Fed probably going to raise rates in December. The economy there is pretty robust, employment certainly very robust, and we don't have the oil shock this year. So that's helped the US economy along a bit. In Europe, the tone has changed. It's not more and more QE, it's, well, actually, no, we're sort of comfortable where we are at the moment, and maybe the message needs to be, I think, from central banks, QE has done its job, it's time to pull back a little bit. I think market players would be very happy to hear that.
I know you were at a conference recently and you had a notable quotable from Mr. Volcker. Would you like to share?
Yes, so Paul Volcker at the conference, of course, he's the man that fought inflation in the 1980s and finally brought it down to the levels that it's at, slightly above the levels it's at today. But his point of view was, what's all the fuss about? We hated high inflation, now we've got what I fought for. Everyone's unhappy again.
I guess what the market's afraid of is deflation. And if QE actually is ending, are we likely to see deflation?
I think not. We haven't had deflation, despite the fact that it's been a constant fear. We've had low inflation. Inflation's going to pick up a bit, actually, in the near future because the oil price is now beginning to go up, not down, so that will affect the inflation numbers. So now I think we're out of the woods on deflation. And as long as it's constrained to things that we buy from abroad, that's okay. It's deflation in wages, which we've never had, is the real worry there.
Okay, so the underlying economic activity seems around the world to be all right. Maybe not gangbusters growth, but fairly consistent, low, steady growth, which you could argue is not a bad scenario. In that environment, and in a background of QE sort of gently heading out the back door, fiscal policy becomes more prominent in figuring out what happens to markets and what happens to economies. In order to figure out what fiscal policy looks like, we have to look at who's going to be in power, and of course we have the question of elections and referendum. You have to start with the Donald and Hillary show. Tell me what you think of what's going on back in my favorite country.
So both candidates are promising fiscal stimulus of a kind. So you're absolutely right. Austerity is over. Will they get it through Congress? So that's the real problem from a capital markets point of view. So I think if you had Trump win and a Republican Congress and a Republican Senate, yes, you have a mandate, you have the power to do some of the things that he's talking about, and I think uncertainty would increase. If Hillary wins, you've almost certainly still got a Republican Congress, probably a Republican Senate. So you've got this logjam that we've got at the moment, just carries on with a very acrimonious dispute between the President and the Houses of Congress and Senate, but nothing getting done.
So in terms of what 7IM is looking for when we're managing our customers' money, as you would hope for a soft Brexit, from a portfolio management standpoint, this is not a political statement, you would prefer to see Hillary with a Republican Congress.
I think we always want preservation of the status quo because it means less uncertainty. And let's not forget, the economies around the world are growing. They might not be growing as fast as people would like, but to go back to Paul Volcker's comment, we've got low inflation and economic growth that is continuing on, is pretty durable. That's not a bad situation.
Okay, so having had a very and unexpectedly good Q3, markets were very buoyant. Our portfolios participated in that buoyancy to the full. We benefited from the currency maneuvers that you made surrounding Brexit. You now, having shifted emphasis from the central banks to the political landscape, not as clear vision as we would like to have at this point in time. So you've taken some risk off the table.
Yes, I think you've got uncertainty obviously around Brexit. You've got uncertainty in the US, and of course in Europe it's not that clear either, with these populist, non-mainstream parties becoming more and more powerful. So we've taken off European stock. We've reduced our exposure to European stock markets.
Quite a bit, huh?
Quite a bit, yeah. We took 5% out of our balanced funds recently, and that's just really to say we don't know where the populist surge in Europe is going to end. We've taken 4% out of our US stock market exposure, again in our balanced funds. And that's to say, we just don't know what Trump means. And he is closing the gap on Hillary. So that gap was very wide a month ago. It is now very close. So we can't rule this out. And, we learnt from the referendum that we can be wrong and everyone can be wrong on what they think is going to happen.
You also learned the value of protecting against tail risk when it came to the referendum, when you kept your dollar exposure. So here, you're again protecting against a Trump outcome, or Trump with a Republican Congress outcome, yes, which would potentially be even more severe in terms of policy making. And that leaves us with about how much equities in a balanced portfolio?
So we're at about 35% equity, down from about 47 in our balanced portfolios, and we've kind of beefed up our safe havens a bit. We've diversified them and put some more clear tail risk mitigants in place.
Great. And cash levels?
Low to mid-teens in the balanced portfolios, and kind of up and down proportionately from there in the various.
So would it be fair to say that when we get a little better vision as to what's going on from a political standpoint and the resultant policies, that we would maybe then be prepared to put that cash back to work?
I think we'd like to see political risk being resolved. We'd also like to see economic data getting a bit stronger, because it's been a bit weak recently. And we'd like to see earnings, coming through a bit. Certainly expectations for earnings are a bit better, but they're not massively better.
So, long story short, economically we've got a fairly stable world. From a central bank standpoint, looks like the beginning of the end of QE is on the horizon. From a political standpoint, we've got the uncertainties, and because of those uncertainties, we've taken risk out of the portfolios for the time being, and that's the kind of thing that we need to do to protect your capital. As these events unfold over the next quarter, we'll see what that cash position looks like and how we employ it. But Chris, wonderful job over quarter three, and we look forward to seeing you again toward the end of the year. Thank you.